If you're thinking of buying a home this year, you may be wondering, well, how much money you need to come up with for your down payment. Many people may think it's 20% of the loan to secure a mortgage. While there are plenty of lower down payment options available for qualified buyers who don't want to put 20% down, it's important to understand how a larger down payment can have great benefits too. The truth is, there are many programs available that allow you to put down as little as 5%, which can be a huge benefit to those who want to purchase a home sooner rather than later. So if you only have a small amount of money put aside and it only comes up to 5% of the purchase price, you can go ahead and do that right now if you qualify for one of those programs. But I also wanted to share with you 4 reasons why putting 20% down is a good plan if you can afford it. The first one is your interest rate may be lower. A 20% down payment versus a 5% down payment shows your lender that you're more financially stable and not a large credit risk. So the more confident your lender is in your credit score and your ability to pay your loan, the lower the mortgage interest rate they'll likely be willing to give you. The second one is you'll end up paying less for your home. The larger your down payment, the smaller your loan amount will be for your mortgage. So if you're able to pay 20% of the cost of your new home, at the start of the transaction, you'll only pay interest on the remaining 80%. If you put down 5%, for example, the additional 15% will be added to your loan and will accrue interest over time. This will end up costing you more over the lifetime of your loan. The third one is your offer will stand out in a competitive market, in a market like we're currently having right now. In a market where many buyers really are competing for the same home, sellers like to see offers come in with 20% or larger down payments. The seller gains the same confidence that a lender in this scenario would. You are seen as a stronger buyer with financing that's more likely to be approved. Therefore, the deal will be more likely to go through. You won't have to pay the CMHC premium. The CMHC mortgage loan insurance premium is calculated as a percentage of the loan and is based on the size of your down payment. So the higher the percentage of the total house price value that you borrow, the higher percentage you will pay in insurance premiums. Many times, home sellers looking to move up to a larger or more expensive home are able to take the equity they earned from the sale of their house to put down 20% on their next one. With the equity homeowners have today, it creates a great opportunity to put those savings toward a 20% or greater down payment on a new home. So if you're looking to buy your first home, you'll want to consider the benefits of 20% down versus a smaller down payment option. And if you have specific questions to your unique situation, you can always head over to planwithmike.ca, select a time and day that works for you, and let's have a chat.